Okay, so thanks for being here. So this is a joint work with Angelo Ranaldo from the University of St.Gallen. I guess many of you know him. And it's a paper about the quality of markets for cryptocurrencies. In particular, we're looking at centralized versus decentralized exchanges. So decentralized exchanges are an important component of DeFi, of decentralized finance. So basically, they are fully on-chain, and they allow people to keep the custody of their assets. So basically, you keep your tokens in your non-custodial wallet, and then you can interact with the smart contract underlying the exchange in order to trade among currencies. So this is a screenshot from one of the leading decentralized exchanges, Uniswap. So you can see the interface is pretty simple. Here I'm connected using my wallet, and then I can trade, some ETHs for some stable coins, for instance, and they call this operation swap. But basically, this means that I can convert one token into another token, and this is a settled transaction. So once it goes through the smart contract, then I would, find this amount of USDC in my wallet, and that's it. It's done. So these decentralized exchanges do not use a limit order book. So that's the main difference with respect to centralized exchanges like Binance or Kraken. And the main reason why they don't use this model is that this is simply not feasible for a blockchain. Meaning that in limit order books, liquidity providers are constantly updating their quotes, every millisecond. And this would not be possible on a blockchain where you have to pay for every single transaction, and when it takes, a few seconds, between 10 and 15 seconds, in order for the transaction to go through. So basically, they rely on a different model, which is based on liquidity pools and liquidity providers. So from a high-level perspective, liquidity providers can deposit or stake some coins in liquidity pools, and then traders or people who are doing these swaps take advantage of this deposited liquidity. And liquidity providers have an incentive to provide the liquidity because they pocket the transaction fees paid by the traders. There is also a risk to liquidity provision, but we are going to talk about this later. So basically, the liquidity provider may choose an exchange pair between a token X and a token Y, and they deposit some liquidity in the pools. And the first liquidity provider, the one who actually creates the exchange pair, can decide the quoted price. So that's going to just be the ratio between the number of tokens Y and the number of token X in the other side of the pool. Okay. Then other liquidity providers can provide additional liquidity, but only at that current ratio. Okay, so adding or removing liquidity does not change the quoted price. The price instead changes when traders use the available liquidity. Okay, so whenever people trade, basically they take in some X, they take out some Y, and the price changes according to a specific mathematical rule, which is called the constant product rule in the case of Uniswap. Okay. By the way, these markets here are also called automated market making. Okay, because the market making is actually controlled by a smart contract, so it's automated. So let's assume that a trader wants to swap a quantity delta X of a token for a quantity delta Y of another token. Okay, so basically it's giving in delta X, so this is going to increase the left side of the pool, and it gets delta Y in exchange. So the question is, how is the price determined? So how many tokens delta Y does the trader get? Well, the pricing is regulated by this constant product formula. Okay, so basically the product between X and Y should be constant before and after the trade. Okay, then you can easily solve for delta Y in this equation, and that's going to be the transaction price, basically. Or more precisely, the transaction price is actually delta Y over delta X, and it is given by this formula. So actually, as we said before, the quoted price is simply Y over X, while the transaction price is different. So of course, there is an increasing spread, which is paid by the trader, or implementation shortfall, if you want, which is increasing logarithmically on the traded size. And the spread is given by this formula. So it's just delta x over delta x plus x. So you can see that if delta x is very small compared to the available liquidity, then the price impact or the beta spread is going to be almost zero, while it increases if the traded amount is closer to the available liquidity in the pool. Okay, so in this paper, we're going to try to run a simple market quality analysis of decentralized exchanges in comparison with centralized exchanges, okay? So we're going to focus on two dimensions of market quality, liquidity and price efficiency. So for liquidity, we're just going to try to measure transaction costs, okay? And those involve three different components. So you have the spread or the implementation shortfall we just talked about. Then we have some exchange fees charged by the exchange. And then we have the gas fees that you have to pay in the case of decentralized exchanges to submit your transaction on the blockchain. And also you have some deposit withdrawal fees for centralized exchanges, which are also dependent on the gas fees. For price efficiency, we are going to look at deviation from the law of one price on triangular exchange pairs. So basically, we consider three cryptocurrency pairs. We know that according to the law of one price, this condition should hold, and we look at the deviations from this no arbitrage condition. Okay, so this is mainly an empirical paper, so we rely on some different data sources. So for centralized exchanges, we have limit order book data for Binance and for Kraken. Okay, so those are among the largest and most liquid centralized exchanges for cryptocurrency. And about DEXs, about decentralized exchanges, we have data for Uniswap v2, and most of the paper is actually based on that data. But we also have some data from Uniswap v3, so a new version of the decentralized exchange protocol. And this data is actually publicly available, so we got it directly from the Ethereum blockchain. We have about 1 year of sample period, and we focus on 6 currency pairs involving ETH, Bitcoin, the two, famous stablecoins we talked about previously, and also Link, which is another cryptocurrency. Okay, so how do we measure liquidity on centralized exchanges? Well, this is pretty standard. Okay, so we have these 3 components I was talking about. So the first one is just the implementation shortfall. So we compute the volume-weighted average price of a transaction, and we divide by the quoted price. Okay, so we do it for a buy transaction, a sell transaction, that we take the average. Then we have F, so those are the exchange fees, or the taker fees, if you want, charged by the exchange. So for Binance, that amounts to 10 basis points, while for Kraken, it's 26. And then we have this deposit and withdrawal fees. Okay, so let me spend some time on that. So basically, we are assuming here that the trader does not keep her tokens inside the exchange. So we are assuming that the trader has full custody of the tokens. So the tokens are sitting in a non-custodial wallet. And then whenever she wants to trade, she first has to move the tokens inside the exchange, makes the transaction, and then she has to withdraw the funds, the resulting funds. So basically, the deposit operation is a transaction on the blockchain that the trader is making. So this is subject to gas fees. So the trader has to pay the gas for this blockchain transaction. For the withdrawal, instead, it is the exchange making the transfer. Okay, so the user is not paying the gas fee directly, but rather it is charged by the exchange. So paying the gas fees indirectly. Okay, so we express this in percentage terms relative to the traded amount. And we do this for different trade sizes, okay, from $1,000 to $1 million. Similarly, for decentralized exchanges, we have these 3 components, the transaction costs, okay? So the first one is the equivalent of the implementation shortfall. So that's this simple mathematical formula I showed you before. Then we have the exchange fees. In this case, for Uniswap, is 30 basis points. So those are the fees which are pocketed by the liquidity providers. Okay, so if you provide liquidity on a pro rata basis, you will get these exchange fees. So the more volume is generated on the platform, the higher the profits. And then we have the gas fees required to submit a transaction. So this is just the total gas cost divided by the traded amount in US dollars terms. So maybe I should spend some more time on the gas here. Maybe not all of you are familiar with this concept. So on the Ethereum blockchain, whenever you want to submit a transaction, so this means that you want to transfer some tokens to another address, or you want to interact with a smart contract, you need to pay the gas fees. So that's the product between the number of gas units required for that specific transaction, so that's proportional to the computational cost of the transaction, multiplied by the current gas price. Okay, so that's the price of 1 unit of gas, and it is decided in equilibrium by market participants. Okay, so this G here is the product between these two quantities expressed in dollars. All right, so this is what we get once we compute these metrics for our 3 exchanges. So here I can show you the transaction cost for $1,000, $10,000, $100,000, etc. This is in a logarithmic scale. And you can see that for $1,000, for most of the trading pairs we are considering, actually Uniswap, the pink bar here, is a bit more expensive with respect to the centralized counterparts. And you can clearly see that Binance is the most liquid exchange. Okay, so it is the cheapest across trading pairs. I mean, of course, if you trade $1,000, the gas cost is going to be very, very important. It's going to be very heavy because that's a fixed amount that you have to pay. It doesn't depend on the traded amount, right? So in percentage terms, that's going to be very, very important, both for centralized and decentralized exchanges. If you go up with the trade size, for instance, for $100,000, you can see that the level of transaction cost is lower on average. The main reason for that is that the gas is not so important at that point. If you move to $1 million, then of course the transaction costs are increasing again, and the main reason is that the levels of liquidity, is not enough to support such a big trade size. So the implementation shortfall here is the most important component. Okay, but all in all, we can see that more or less the transaction costs that you bear on Uniswap are relatively similar to those that you would have on Binance and Kraken, okay? We are talking about the same order of magnitude, even though Uniswap is a bit more expensive. Then we move to price efficiency. So as I told you before, we have this no arbitrage condition on the 3 exchange prices. And then we measure the deviation from that by theta. And so basically, we know that a triangular arbitrage trade is profitable if and only if the deviation is large enough to cover for the transaction cost. Okay? So in equilibrium, we should expect the prices to give rise to some level of deviations greater than 0 in absolute value, but those should be bound by some arbitrage bounds, which are increasing on the level of transaction cost. Okay, so you can think of transaction cost as a friction relative to the low one price. So basically, we just compute, the cost of trading or making a triangular trade on each exchange, and then based on that, we derive some arbitrage bounds, which are basically plus and minus the cost of those transactions. It's interesting that in the case of centralized exchanges, you are just making 3 transactions, and that's it. In the case of Uniswap, you can actually make the arbitrage trade into one single transaction. So basically, you can write a smart contract that executes every leg of the triangular arbitrage into a single transaction, and by doing that, you are saving on the gas cost of this transaction. So to estimate this cost, we wrote our own smart contract that does this triangular trade, and then we measure the cost of actually executing one. Okay, so this is an example of what we get for a specific triplet, USDT, ETH, USDC, on Uniswap and on Kraken. So you can see that the dots here are the observed levels of price deviations at an hourly basis, and these are the arbitrage bounds that we derived based on transaction costs. So you can see that for most of the time, the observed prices are actually within the bounds. So we believe that our approach makes sense. And here we computed those bounds for these different triplets in logarithmic scale again. So, the higher the bar, the lower the level of price efficiency here. And we can see that Uniswap, decentralized exchange, is doing pretty badly, right? So the level of price efficiency here is 1 order of magnitude lower with respect to that observed on centralized exchanges. And we identified the main reason for that in the gas costs. Because even if I didn't tell you, when we are looking at this cost here, we are assuming that the arbitrage capital is already sitting on the centralized exchange. Okay, it wouldn't make sense to assume that the arbitrageur is keeping the capital outside of the exchange, especially because it takes some time for you to deposit your funds inside the exchange. So those arbitrage opportunities are usually very shortly lived. Okay, so we expect the arbitrageur to keep the funds inside the exchange. And thereby, the arbitrageur is not paying the gas cost here. Okay, so you see that there is no term related to gas or deposit withdrawal fees here. Well, for Uniswap, this is always the case. You cannot avoid paying the gas price. And so this is pretty heavy here, because it also implies that whenever you run a triangular arbitrage, you need to find the optimal trade size, okay? Because you have this fixed cost, so this induces a trade-off between the price impact that you are suffering for larger trading amounts and the fact that for small amounts, this gas cost is very, very high in percentage terms. Okay, so whenever you want to execute a triangular arbitrage on a decentralized exchange, you actually need to trade a decent amount of money, otherwise it's not profitable. While for centralized exchanges, you may even trade $1, and that's going to be fine. Okay, so because of that, the level of price efficiency here is much, much better on Binance and Kraken. All right, so this is our partial conclusion. So in terms of liquidity transaction costs, centralized and decentralized exchanges are relatively similar. Actually, Binance is doing a bit better. But in terms of price efficiency, decentralized exchanges are having a hard time here. Okay, and the main reasons are that not only the exchange fees are lower, so for instance, 10 basis points vs 30 basis points on Uniswap, but also decentralized exchanges have to deal with non-negligible gas fees, especially when it comes to triangular arbitrage opportunities. But we think this is not the end of the story. So we know that soon version 2.0 of Ethereum will be deployed, actually in about 1 month from now, and this coupled with layer 2 solutions and sharding may actually significantly reduce gas prices and the cost of transactions. So this could have a positive impact on decentralized exchanges. So actually we compared the current situation with a potential scenario where the gas fees are reduced by a factor 500. Okay, and as you can see, in terms of transaction costs, Uniswap would do significantly better. Okay, so it would be on par or even better than Kraken, still, a bit more expensive with respect to Binance. In terms of price efficiency, this is the current situation again, the improvement would be much larger. Okay, so the scale is different here, right? So we are moving from the size of arbitrage bounds at around 700 basis points to 100 basis points, okay? So here, the fact that gas prices could be lower has a huge impact on the level of price efficiency. Okay, but we don't want to stop there. So we know that trading volume on those exchanges is actually, it has been increasing almost constantly. So we may expect, trading volume to increase in those exchanges in the future. So what kind of implication could this have in equilibrium? So is it possible that liquidity provider would be willing to provide more liquidity to the exchanges because of higher transaction fees they can pocket, and thereby the liquidity on those exchanges could improve? Well, in order to tackle this kind of question, we need to think about the trade-offs that a liquidity provider is facing. So on the one side, the liquidity provider is gaining money from trades. On the other side, is suffering from the so-called impermanent loss. Okay, so the problem here is that the liquidity provider is always selling the appreciating token and is buying the depreciating token. Okay, so it's actually always worse off with respect to holding when it comes to the actual returns of its liquidity position. So I don't want to say too much about this, but you know that we have this risk here, which is actually closely related to the adverse selection risk faced in traditional markets by market makers. Meaning that whenever you have liquidity trades that move the price only temporarily, the impermanent loss is going to be zero, while if you have permanent price movements in a specific exchange pair, the impermanent loss is going to be different from zero. And this is actually a plot that shows it as a function of the price change. And you can derive mathematically the impermanent loss, so the difference between holding the two tokens and providing liquidity, and it comes out, it's a very simple formula involving the percentage change in the exchange rate and the square root of this percentage change. So basically, as I was saying, there is a risk-return trade-off here faced by liquidity providers. And because of that, I don't want to go into details because I'm running out of time, but it turns out there exists a level of optimal liquidity that liquidity providers should deposit into the pools. And this level is basically proportional to the transaction fees charged by the exchange times the expected volume, and it's inversely proportional to the expected impermanent loss. Okay? And so assuming that this is actually true in equilibrium, we can use this equation to link a potential change in volume to the resulting liquidity and fees. Okay, so basically, if we expect the trading volume to go up, okay, then it could be the case that liquidity providers are willing to post higher liquidity in the pools, or they are willing to accept lower exchange fees, okay, given that the risk, the impermanent loss is constant, right? So basically, well, first of all, we fit, we compare our model to data, so we have daily observed levels of liquidity for 100 different trading pairs of Uniswap. So we have our model predicting a level of liquidity, and we have the observed one, and we can see that it lines up pretty well, so the R-squared is 92%. So in order to make this exercise, we actually proxy for the expected impermanent loss by looking at the realized impermanent loss over the last 2 weeks for every specific pair, and the same for the expected volume. So the expected volume is just proxied by a rolling average of the observed volume. Okay, so I think this shows that our very simple equilibrium model here is actually capturing this trade-off pretty well. So it can explain the variation in observed liquidity provision. Okay, so now we can use this model and see what could happen in case there would be an increase in volume by 6 times, okay? So also under the assumption of very low gas fees, then this could imply, according to our model, that the level of liquidity stays the same, but exchange fees are reduced from 30 basis points to 5 basis points, okay? And this would actually imply that regarding transaction costs, Uniswap would be, the leading exchange here, okay? And we believe that this 6 times increase in trading volume is actually feasible in the future. And the same goes for price efficiency. So actually, under these assumptions here, Uniswap would be highly competitive with Binance and actually more price efficient with respect to Kraken. Okay, so I think my time is up. So you have the last slide. So, to conclude, we believe that decentralized exchanges based on automated market making are an interesting innovation from a technological perspective and from a financial perspective. At present, the liquidity properties of these two kinds of exchanges are similar. However, decentralized exchanges are having a hard time with price efficiency because of high gas prices and exchange fees. However, we believe that in the future, decentralized exchanges have the potential to actually surpass and become more competitive with centralized exchanges. All right, thanks for your attention.
Okay, hello everyone. Thanks, Matteo, for inviting me to discuss the paper in this session. Before I go, a couple of obligatory disclaimers. I'm actually very surprised that my central bank colleagues didn't read aloud what they're supposed to read. That all the views that I will express here are my own private views. They don't express views of Securities and Exchange Commission, Securities and Exchange Commissioners, and Securities and Exchange Commission staff. So these are just my views. Again, I'm forced to say that every time I speak publicly. And second disclaimer, when I was reviewing paper, I looked at the April version of that paper. And a few days ago, Andrea sent me an updated version of the paper. Unfortunately, I was on vacation, so I didn't have time to properly review it. So my slides might be a little bit stale, so my apologies. I tried to remove items that Andrea already took care of in the last moment, but there might be some leftovers that are irrelevant. But I'll try to be as relevant as possible. Okay, so my job here is twofold. One is to provide some technical comments to the paper, what I see as potential deficiencies that could be resolved, could be helped the paper. And my second job is to frame the paper into kind of big picture, like what we learn from this paper. We, meaning the audience of readers of the paper. So kind of first, very quickly, what the paper does. Well, this one is the first paper that actually analyzes two alternative approaches to trading, the execution of trades, centralized limit order book versus decentralized automated market making. This paper looks at this trade-off between these two types of trading from two market quality points of view, liquidity and efficiency, and identifies the limits of growth to, in particular, to decentralized exchanges, and finally identifies optimal parameters for decentralized exchanges to be dominant in the market according to these two variables. And I would like to highlight that this is kind of view on competition between these two types of market from this point of view, from these two, from liquidity and market efficiency. Okay, so let me give you my kind of big picture view of this paper and decentralized exchanges in general. So here I will be wearing a little bit of a regulator hat rather than academic economist hat. So these points might not applicable to this paper only, but kind of bigger view of decentralized exchanges. So first of all, this is a new way to new model of liquidity provision on the market. And while we think about decentralized exchanges as kind of very, very crypto, it could be possible that this approach might be applicable to traditional markets. Maybe this is a better mechanism than limit order book. So who knows? And therefore, we need to study it. And it's a completely new model, totally novel, but financial innovation might not be crypto only. It might apply to traditional finance as well. And it's very important to study this new model. And thank you for taking on this issue. One very important terminology point. And here on one hand, I understand Andrea and his co-author choice of words. On the other hand, I actually have objection to his choice of word. So first of all, the paper defines centralized exchange versus decentralized exchange in terms of trading mechanism, limit order book versus automated market maker. And I think that's what the paper should use throughout. Why? Because generally speaking, decentralized exchange is a very, very big misnomer. And for the purpose of this presentation, for my discussion, I accept this terminology, but generally I have objections to that. Because if you dig deep enough, most, if not all, decentralized exchanges have central controlling party somewhere. Whether it is in the governance or the dominant trader or somebody who controls the smart contract driving that exchange, controls execution, controls something. And generally speaking, kind of decentralized exchange or decentralized anything is a big misnomer. And I don't like to use this word here, especially here because the real distinction in the paper is not centralized versus decentralized, but limit order book versus automated market maker. I understand that will make it more complex and maybe less interesting title of the paper, but I just want to point out this distinction in terminology. Okay, so next big picture view is about what this paper considers as important considerations. So again, paper looks at liquidity and efficiency as two variables. However, I just would like to point out that market quality is not the only dimension of the difference between centralized and decentralized exchanges. So, in my opinion, kind of the description of other distinctions between these two models is somewhat incomplete in the paper. And I understand that this is outside of the scope, but I just feel that the discussion highlights advantages of decentralized exchanges, but kind of doesn't speak enough about disadvantages of decentralized exchanges to the end users. And I just, kind of paper dismisses a lot of kind of intermediary functions that centralized exchanges perform, and kind of implicitly assumes that decentralized exchanges is what the user wants. I think, again, this is market intermediaries perform a lot of useful functions. When I deposit my money into a bank, I don't want to know how my bank works. I just want to make sure that it's stable. That's it. I don't care about intricacies of banking system, intricacies of how capital requirements work, and so on and so forth. As a user, I don't care. As a trader, as a user, like, you know, a regular retail user, retail trader, I probably, to be honest, I like intermediary to take care about a lot of things. Screening of the trading pairs, or maybe how liquidity, I don't care how liquidity pool works. I like my market intermediaries. So I think this discussion is a little bit lopsided in the paper. And final big picture item is this one. So we learned a lot, I hope that we learned a lot in the DeFi. One of the DeFi protocols collapsed in the spring of 2022. And I think this paper should at least touch on this discussion, what we learn about automated market making based on spring 2022 events. And I will return to this point again later on. Okay, so now directly to the paper, and I have a couple of conceptual concerns about the paper. Okay, so first item, the paper basically identifies kind of the gas fee as the most important, the gas price is the most important distinction between two models, two trading models. And I have a little doubts about, is it the only structural difference between these two models? Or there might be some others. And I think there is some kind of more robust discussion here would be beneficial. What happens if backbone switches to another model, proof of stake, and I think Andrea in the newer version addressed it at this point, but I believe in the previous version, this discussion was really not there. Okay, so another consideration is about gas price. So again, gas price is the most important variable in this paper. I want to learn more about it. And I think you kind of, you kind of brushed under the carpet. And I would like to see more about how variable it is, but even more important, how it is correlated with other variables. Why? Because you kind of touch upon this issue that gas fee might reflect overall liquidity conditions of the market, and gas fee might be correlated with liquidity pool size, so liquidity providers might be responsive to the gas fees. And I think this is a big item that is missing in the paper. Like, I don't know what, it looks like gas fee is fixed. Actually, going all the way even to notation. So you have F to denote fixed fee, which is constant throughout the paper, right? And you use letter G to denote gas fee. But it also looks like a constant gas fee. But actually, it is time variable in your empirical work, right? But when I read the paper, when I read all the formulas, it looks like F and G are kind of equivalent constants. But in fact, G is actually time variable. And I think even simple notation might help the reader to understand that gas fee is actually variable. But if we forget about notation, kind of generally, how variable is gas price and how it is correlated with other variables? And I suspect there is a lot of endogeneity there that might be important consideration. Okay, so next issue is liquidity pool size. So liquidity pool size doesn't really enter the picture here. I understand the kind of the algebra of your approach, and I see X, the size of one side of liquidity pool in the transaction cost, but I don't see Y. So it looks like if I have tiny X supply in the liquidity pool, and it doesn't matter whether I have huge Y or tiny Y, it will be the same transaction cost. I find it very, very counterintuitive. So again, I checked the algebra, it looks good, but I'm missing something. Maybe I'm just not smart enough to understand that, or maybe I need a little bit hand-holding. Where is Y? Where is Y in all this considerations? But again, the more important is liquidity pool dynamic. And again, there are some papers, I have seen a couple of papers which kind of look at joint determination of gas fees and liquidity pool size. And I wonder if that would be an important consideration here. Liquidity providers can jump between liquidity pools, and that's one of the advantages of DeFi protocols and DeFi exchanges. And I don't see liquidity pool size getting anywhere here. Okay, and it kind of gets into, I don't know, I don't want to call it competing paper, but paper which looks at very similar issue by Lehart and Parlour. And for them, I think liquidity pool size is actually a very important variable in their paper. I would like to see, kind of highlight a little bit more what's different between these two papers and why you arrive to somewhat different conclusions. And again, liquidity pool size is probably the most important here. Okay, so going back to my point about crypto winter or crypto spring, which happens in the spring of this year. So your results are basically based in 2021, time of rapid growth of DeFi space. Well, this paper would look like trying to estimate permanent growth rate of housing market based on 2004, 2006 data, and then applying it for the future. So using any estimates based on the episode of rapid growth of any market might be very misleading. I know that it's difficult to collect the data, but for me, if your paper doesn't have any estimates which would capture maybe not the May crisis of DeFi, but at least time of not rapid growth of DeFi would be very helpful. Also, I don't like your word supremacy, to be honest. It's maybe a little bit too much for me. Okay. The word supremacy, it's have negative connotations for me. So I would like to use something like advantage or not. Okay, so Matteo tells me that I should be done, and I am almost done. I actually had a full slide here based on April version of the paper about ways to better present certain results and a few couple of actually very, very important typos. But Andrea already fixed all of those, and only one item here is that you have a lot of repetition in your figures. So I think these are figures 8 and 9 in the new version. But if you carefully look at the figures, you will discover that actually you can condense them into much smaller number of figures. And it will be much more, convey information you want to convey in a much better way. And also kind of the same figures So USD Bitcoin to use Bitcoin to set Tether is the most actively traded pair in your summary statistics, but you excluded it from your analysis. You kind of brush it off. I take these 5 pairs instead of 6 I have in my summary table, and I drop the most important pair. Why? So I have as a referee, I have suspicion something doesn't work in that pair. Why drop the most actively traded pair? Again, maybe simple explanation, but you should provide it. Okay, and the final conclusion. So this is an excellent paper. I think it contributes to discussion. I think it would be very useful for us. Even if we don't want to do anything with crypto, it would be important for us to understand how this model works and how useful it is. It's a little bit of work in progress, and again, for me, the most important part is dynamic interaction between variables. So you essentially assume kind of everything fixed. There is nothing going on between variables. I think that's the biggest thing that's missing in the paper. So thank you.
Thanks, first of all, for inviting me to this conference and giving us the chance to present. This is a co-authored piece between myself and a friend and colleague of mine, Ganesh, at the University of Warwick. And it's a bit of a change of pace, change of gear compared to the previous paper. This is a DSGE paper looking at macroeconomic effects of introducing cryptocurrency, right? So I just want to take a bit of time to position the paper. So if you think back, and if you think about the papers written by Helene Ray, Silvia Miranda Agrippino, Dedola and co-authors about global financial cycles, we want to position this paper in that literature. That is to say that what should a small, open, emerging market economy do in the face of these global financial cycles? And of course, we were motivated and inspired by El Salvador's decision to adopt Bitcoin as legal currency, right? Now, in hindsight, probably not a good idea. But at the time, there was a lot of momentum for Bitcoin adoption, a lot of discussion and whatnot. And so we wanted to think and figure out, okay, well, yes, small emerging market model economy in the face of global financial shocks, these sorts of taper tantrums and sudden stop shocks, what should you do, okay? And so some of the research questions that emerged from that are the following. So what are the welfare implications? How should the central bank conduct monetary policy? And what can the model say for fixed and floating exchange rate regimes, okay? So if we have time today, hopefully I can take you through 3 shocks, 3 simulations that will answer these questions. Okay, so like I said, the paper was emerged from this global financial cycle literature, right? And on models or papers by, say, for example, Aoki, Benigno, Kiyotaki, Obsfeld and Gurenchas, for example, right? And it's inspired by, as I said, El Salvador's decision to adopt Bitcoin as legal currency, okay? Particularly at the time, there was a lot of discussion, still is, a lot of discussion about adopting a cryptocurrency as volatile as Bitcoin versus a stablecoin solution or a CBDC, okay? I've mentioned this already, but basically, as I said at the start, this is a DSG paper, right? And so what it is, it's we build a small open economy model with 2 representative agents, banked households and unbanked households. There is a banker, a financial sector that drives a lot of the macroeconomic results in the model. And we then add cryptocurrency or Bitcoin to the model, okay? And as I said today, I want to take you through these 3 results a global financial shock, a discussion about fixed versus flexible exchange rates, and what the model can say for welfare. Okay? Right. So, now, this is probably common knowledge now, but basically, a lot of the motivation for why El Salvador decided to take up Bitcoin was, of course, to reduce remittance costs, right? And, of course, to address the financial inclusion problems, or rather the lack of financial inclusion. That is, many households in El Salvador do not hold a bank account. Okay? So the adoption or the introduction of a digital wallet based on Bitcoin was seen as a way to address that financial disinclusion problem. Okay? And so there was, I won't spend too much time on this, but basically there was a trial period as well in El Salvador to introduce Bitcoin, to create a Bitcoin beach and see how Bitcoin could be used as a medium of exchange and transaction between locals and tourists, for example. And this map is basically a location of Bitcoin ATMs throughout El Salvador. And it's basically to highlight the fact that, okay, well, now you've taken these households who don't possess a bank account for various reasons. But, well, if you give them a Bitcoin wallet, now they have access to ATMs, they can withdraw cash and whatnot, that's seen as some improvement into this, right? Bitcoin, and this is fairly dated now. It doesn't include the spring of this year, but this is a plot of Bitcoin prices and, of course, the daily returns of Bitcoin for the same period. Okay? And as we know, in recent times, this has taken a tumble. Okay? Now, I won't spend too much more time on discussing El Salvador and Bitcoin specifically. There's a very good working paper published in the MBER that discusses the effects of this policy and assesses how effective it was. Okay? So I encourage you to go and read that paper. Okay? I want to just move on now to the model, which we'll use to address some of the research questions that we posed at the start. Okay? So, first, just very broad overview of the model. So, it's a small open model economy. You have two households, regular workers, we call them, and these households, or these workers, have a bank account, so they can smooth their consumption very efficiently. Right? Standard sort of Ricardian households. And then we have unbanked workers, who, for the purposes of this model, you can think of as hand-to-mouth households. Okay? Prior to introducing Bitcoin or digital currency into the model, these households have no access to savings. Okay? All their consumption is fueled by wage income. Okay? Once you add in Bitcoin, then they have at least some medium or some method of smoothing their consumption. Okay? What else do we have in the model? We have firms which take up loans from bankers. Bankers intermediate most of the financial flows between households and firms, and of course from an overseas sector. So the idea of this model is, think back to Gertler and Kiyotaki, or the Aoki Benigno Kiyotaki working paper. You have a banker who receives deposits from regular workers and foreign deposits from foreigners, and then lends out the money in terms of equity to firms. Okay? Now there are two other things. One, in our model, because we introduce Bitcoin to the unbanked workers, the bankers also take in Bitcoin deposits, right? And also, there are some inefficiencies in the model or in the intermediation. One, regular workers can also lend directly to firms, right? Purchase equity, but there's a cost, some deadweight loss. And the bankers, if they decide to take up loans from foreign savers, there's a deadweight loss for them as well. Okay? And just, yes? Correct. Over there, it's not so much on a, there's not so much of a payment, like a deposit, like in a regular bank account. No, it's more so the value. But in this model, we're simply saying that we're making the assumption that a bank offers a Bitcoin deposit scheme that is similar to a normal deposit scheme. So the answer to your question is no, but for the model, we assume yes. Okay. All right, so this is the utility function and the budget constraint of the regular worker. Okay. So Greenwood-Herkovitz-Hoffman utility, GHH preferences, right? So that's to capture some of the pro-cyclicality in emerging markets, right? So household gets utility from consumption, disutility from labor, and for the case of the regular worker, the banked household, of course you have the regular components, you have consumption, equity holdings, the cost that the regular worker incurs giving equity to firms, and bank deposits, D. So D are regular bank deposits, okay? On the revenue side, you have wage income, of course, profits from firms, return on the equity from the previous period, and return on deposits. Okay, so this is all standard. This is a standard Ricardian household. Okay? Now, on the Bitcoin household, or the unbanked worker, right? Much the same way, they get utility from consumption, disutility from labor, but we also assume that there is some pecuniary, non-pecuniary benefit, rather, from holding Bitcoin holdings, right? That allows them to interact with the broader financial system, okay? And their budget constraint is, of course, they spend on consumption, but now, of course, they can choose to hold Bitcoin holdings, and they earn a return on their Bitcoin, okay? So this is the strong assumption that we make in our model, right? Where the return on Bitcoin is essentially is governed by an exogenous price process, okay? Okay, now, hopefully that's not too hard to swallow. Then we go to the banks, okay? Now the banker operates as in Gertler and Kiyotaki. They face a financial friction, a moral hazard, whereby in each period the banker can choose to either abscond or operate honestly, okay? And basically what happens is that the banker faces this incentive compatibility constraint where it always wants to keep its franchise value above this quantity here, where theta is the fraction of assets that it can abscond with, take and run, and that's multiplied by its total equity holdings. Okay? And how does the bank look overall? I'm not going to go too much into the details, but the bank's balance sheet looks as so. On the asset side, you have loans to firms, right, where KTB is denoted as is the equity holding of a particular bank, right? And then you have management costs. This is the management costs of intermediating foreign debt. And on the liability side, you have, of course, deposits that regular households, non-Bitcoin households have. Bitcoin deposits, of course, foreign debt, and its own retained earnings or its net worth, okay? And you could express the bank balance sheet in this equation 8. And then there's a flow of funds constraint for the banker, okay? Expressed by number 9, right? Where net worth is the net profit that the banker takes after all these expenses. And now, basically, because this is a small open economy model, we need to now think about uncovered interest rate parity and some of the drivers of the model. Okay? So, these are the equations that essentially causes the financial accelerator effect in this particular model. Okay? And so, mu is the return or the premium of equity over deposits. Mu C is the excess return of cryptocurrency holdings over deposits. Mu star is the foreign debt equivalent, and epsilon is the marginal cost of deposits. Okay. So now, The rest of the model, fairly standard. Firms, it's a new Keynesian model. You can use either Calvo pricing or Rothenberg pricing. That's all fine. They're sticky prices. And the final good firms themselves, standard, they export. The only one thing to note, though, is because we want to try and capture some of the discussion in the global financial cycle literature about whether or not you can have export-led growth or not, the intermediate firms, one of the inputs into their production are imports. Okay, so they take capital, labor, and imports to produce output. Okay, but the rest, everything else, standard. Okay, monetary policy, the central bank operates a very simple Taylor rule, where the only twist that we add is that we include the nominal exchange rate. Right? And this is because we want to consider the case of, well, what about if you operate monetary policy with a fixed versus a floating rate, okay? Whereby, so this is from Gali Monticelli, where basically omega E denotes how strong you are to either a float or a fix. Very low values of omega E, close to 0, go to a float. And very high values of omega E to 1 denote a fixed exchange rate. For the baseline, we calibrate to 0.5, so it's like a dirty float. But we show later on in the simulations what happens if you calibrate this to 0.1 versus 0.9. Okay? That's it. Okay? And some additional equations for the exogenous processes. Okay? So that is that only the unbanked households have Bitcoin holdings. Okay? We can amend this, and in the appendix of the paper, we also allow the banked households to hold Bitcoin holdings. That doesn't change the results significantly for reasons that I'll get to soon. And then we have these exogenous processes for productivity and the price of Bitcoin. Okay? Okay, so model simulations. 5 minutes. Okay. So I didn't know how big the projector was here, so let me highlight some of the key diagrams, key plots. So here we have net output, aggregate consumption, labor supply, capital investment, exports. And on the second line, we have most of the banker variables. Right? The key ones to look at are this one, the real exchange rate, the nominal exchange rate, and then net worth. Okay? And on the bottom row, we have either the unbanked household variables or the banked household variables. Okay? So what we've done here, though, the first shock is a standard deviation shock, decrease rather, to the Bitcoin price. Okay, and this is for the baseline calibration where the central bank does not operate a full float or a full peg. Okay, so a decrease in the Bitcoin price or cryptocurrency price, right, causes a peak decline in output of about 8%. Okay? Why does it go back up? Well, because it's like a price decrease in the very next period, it becomes an increase in the return. So there's some rebound, but the contractionary effects dominate the late expansion effects. Okay? Now, how does that work? Well, I'll get to that, how that works once I show you the foreign interest rate shock results as well. Okay. This P-star shock summary. Let me just quickly get to this, and I'll talk about the mechanics of how the model operates. Okay. So in this case, these slides they show you a standard deviation shock to R star. This time an increase in the foreign interest rate. Okay. And the red line indicates what we call cryptocurrency autarky. That is a model with no cryptocurrency. So the unbanked households are purely hand-to-mouth, okay? And the dashed blue is the baseline case, okay? Now, of course, predictably, an increase to R star leads to a decline in output and some fairly strong exchange rate depreciations here, right? Now, what are the main mechanics for this? Okay, the main mechanic for this is, of course, everything gets amplified through the banker. Okay, that is that when you're hit with a price shock or an interest rate shock, okay, the liability side of the banker increases. Say, for the case of an R* shock, right? Because you're hit with a depreciation of your exchange rate, your debt holdings as a bank increase. Okay, this means that this inhibits your ability to lend out equity, right? And you take a tumble in your net worth and your profitability. Okay, because then the banker reduces equity lending, right? This is what causes real effects in the economy, right? And because the banker leverages itself as well, the rather small change in the exchange rate or the Bitcoin price leads to a fairly strong effect in the real economy, right? And this is the BGG, Kiyotaki-Moore financial accelerator, okay? And we see similar effects here for either a Bitcoin price shock or the foreign debt shock, okay? That's basically what I've said. Very quickly, let me just quickly show you this picture, well, two more pictures. This is the Bitcoin price shock again, but this time we're looking at red line is a fixed exchange rate, right? And the dashed blue is a floating exchange rate, okay? And the key takeaway here is, if you zoom in, the key takeaway here is you get a much stronger amplification through the fixed exchange rate, okay? And so the policy takeaway, basically, for an emerging market economy, such as El Salvador, is that conditional on making cryptocurrencies illegal tender, a floating exchange rate softens the effects of crypto asset price shocks. Okay, that's one. And two, the second picture I wanted to show you was, well, what do we talk, we were talking about welfare at the start, so what can we say about welfare in this paper? Well, let's take a very simple definition of welfare. Let's take this value function, and let's say we have the welfare for the banked household, the unbanked household, and let's build a synthetic household aggregate, right, the representative, right? And then say, now, how does welfare interact with the volatility of the cryptocurrency in the paper, right? Well, so if we plot the welfare, different welfare for the regular household, the unbanked household, and the synthetic aggregate, right, against cryptocurrency volatility, this is all quarterly, we see that very quickly do you get a decline in welfare, relative welfare, roughly about 4%, okay? What's that? About 4%, okay? Now this is a big problem because if you go back to look at the Bitcoin volatility and see how big the Bitcoin volatility is, Bitcoin quarterly volatility is about 70%. Okay, so you can only imagine how far out I have to draw this graph to show that high volatility is welfare reducing. Okay, and so this is why we say in our paper that, okay, well, one way to address the financial inclusion problem, right, is indeed to introduce a consumption savings device such as a cryptocurrency to the unbanked that allows them to smooth their consumption, okay? If you could do that without introducing the high volatility that Bitcoin induces, then you would get, according to our model anyway, you would get welfare increases, okay? So what we're basically saying is that there's a trade-off. As in most things in macro, there's a trade-off. You introduce Bitcoin, you introduce cryptocurrency because you want to allow the households, the non-recarding households, to smooth their consumption. So in the face of productivity shocks, they can increase their welfare, okay? In doing so, however, you introduce instability, right? So the first best solution is you give everybody a bank account. Everybody uses the deposits, D. Second best to that is rather than introducing a high volatility cryptocurrency, you introduce a low volatility cryptocurrency, such as the CBDC. Okay, so that speaks to the key point of our paper. Okay, anyway, I've gone slightly over time, but again, thank you very much. This is a work in progress. We've submitted it to journals, so any constructive feedback or comments would be much appreciated. So Thank you very much.
Thank you very much for inviting me to discuss this really interesting and valid and absolutely important paper. Okay, so as you were very short on your motivation, I had to dig a bit more into it, also because there were some questions a bit on what we are actually talking about. So basically, you motivate your model and your research question with this case study, I would like to call it, of this Bukele, you see the president of El Salvador, on his pet project, the introduction of Bitcoin in his country as a legal tender. So September 21, this sounded like a good idea. They implemented it through the so-called Bitcoin law, which basically required any economic agent in El Salvador to accept Bitcoin as payment for any transaction that anyone wants to do in this country. And to kind of give the technical necessity to the public, they launched this app that they called Chivo Wallet. You had it quickly on your slides, so that everyone could digitally trade both Bitcoin and US dollar. And they also gave a bit of a carrot to make it even more interesting to download this app. So when you download this app, you get basically $30 US in Bitcoins from the government. And that was actually one of my first questions. Was that during the entire time? So if I would now download the app, would I still get $30 in Bitcoin? Would be an interesting idea to see that over time, but that's not your paper. So, but quickly to follow up on this case study, you already mentioned it, the Alvarez NBR working paper, very interesting summarize of a disaster, basically. So when you look at how it is going, well, overall this experiment was not very successful right from the start, even though most of the El Salvadorians have internet access and mobile phones that could work with that. Only 60% of the population actually downloaded the app, mainly to get the $30, and only 20% of those who had downloaded it actually continued to use it. So here I just brought you from their paper, one of the questions, do you use this app after you used up your $30? And the answer is basically no. So they got for the free cash, but then they stopped working or stopped using it. Why is that? Well, it's also a bit related to the crypto spring, winter, of course, now even more, but already before, the problem was actually who bears the risk. So the El Salvador government established this trust fund to convert Bitcoins. That's also a bit dealing with the question that came about how does it work and who actually exchanges the Bitcoin. So there, how it works, it's the government. They set up a fund, and even though they never really said how many Bitcoins they bought in the beginning, they bought approximately 1,800 Bitcoins, which lost 60% of its value by now, and the government did not successfully raise any additional funds, so they were not supported by the community anymore. So this also led to a collapse of the usage in the public, because you kind of lose the trust that the government can do that forever. So reality showed what also your model shows. It's maybe not such a good idea. So what does this paper do? Actually, you model to evaluate the benefits and the costs of a second tender, which is per se an interesting idea. How do you deal with that? And particularly, what are the consequences if this second legal tender is highly volatile, and I cannot, I as a government or central bank have no impact on that. The pros, as also promoted in El Salvador, was to the financial inclusion of the unbanked population. The cons, well, the high uncertainty created by the volatility of this legal tender. So if the legal tender is very volatile, that's what you get. Then the cons are much bigger than the pros. That's what also reality has apparently shown. And also you mentioned, well, stablecoins would bring the benefits without the costs. And you also talk about how monetary policy could lose its impact if then this stablecoin would be highly adopted. So implicitly, even though you mention it a bit, but implicitly your model brings a bit, makes a big case for CBDC, right? I mean, then you would have all the benefits without any of the costs. So let me make 3 critical or well, more like suggestions of what to think or further, and also for me to understand better. I want to talk about first the actual inefficiency that we see the unbanked population. So that's the problem. That's why you want to do something in the first place. So you have this huge proportion of your households that don't have access to banks. But why are we actually concerned about that? So what's usually when we think about unbanked population, what's the problem? Actually, you have kind of, or I could think of 3 parts of it. It's the first part is a savings part. So if I don't have my bank account, where do I put my earnings? When I can't save properly, then I cannot smooth my consumption properly. That's in your model, and that's also solved by this stablecoin or cryptocurrency usage app that's called Chivo in El Salvador. But I'm, as a banking theorist, think immediately of another problem for unbanked population, the problem of credit. So usually those who have no access to banks are those who would not only need to smooth their consumption and to put all their savings somewhere, but it's usually the people that need some initial funding to basically, well, set up a shop, get into the working life and be, therefore get profitable or have savings in the future. And this is not solved neither by the real experiment nor in your model, right? So the problem is that really the core problem of an unbanked population that we cannot save, or is it about having access to credit? The third one, having access to transaction, this is somehow solved, but also not perfectly, because, especially in your model, because then you can only, basically in your model, you can only trade Bitcoins with other unbanked households and not with the other households. So when you think of the solution for the first problem, then, I mean, if I only need some place to store my money and maybe even get a small amount, small interest on it, then there should be much better solutions than providing a Bitcoin access, even by the banks. I mean, usually the problem is that you have an information asymmetry, and that's why banks don't want to give credit to those unbanked households. But if you simply want to store your money, there are solutions via smartphones, there are solutions with fintech platforms and so on. So why do we have to come up with a very difficult solution to an actual easy solvable problem? Second, that was also mentioned with the transactions, what I was wondering in your model is, when I think of this case study in El Salvador, there was a clear competition between the legal tenders. So everyone, well, 60% of the population were downloading this app, and then I would basically use Bitcoin as long as it gives me an advantage. So it gives you a lower bound on basically where you want to deposit your money, right? If crypto gives me more, I would use crypto. If my bank account gives me more, then I would use my bank account. But in your model, you assume that the banked households simply stay with their deposits and don't access the crypto. I don't know if you can include that, but I thought this is kind of very restrictive also for the benefits of the crypto. And when it comes to the monetary transmission, this plays an important role. And the third question, and here I think I hopefully dig into a point that you brought up, because I had the same problem. Where do the Bitcoins go? And my question is not, I would even be willing to buy that they immediately go into the loans. But then my question is, why does a bank does not have any risk? So the question here is, who bears the risk? Because you talk a lot about the households that bear the risk when they pull out their Bitcoins and go to, well, shop their groceries, then they have to transfer it in the US dollar price, and then they kind of bear the exchange rate risk. But we keep this asset as Bitcoin at the bank, and the bank immediately gives it into the loans, but the loans are in US dollars. So, or it's in real terms bad, in the reality working, or when a bank would be working here, it would have to exchange this into an asset that is in US dollars. So whenever they have to actually take their returns from their asset side and bring it, I mean, if I withdraw my Bitcoin, they have to give me a Bitcoin. So basically, the bank also bears the risk. But this is not in your, so you don't speak about that at all. But you make this assumption that foreign debt has this exchange rate risk, and there's this debt and costs that just go out of the system. So why doesn't this also apply to the Bitcoin? Because at least there should be some symmetry.
So, centralized and decentralized finance, thank you for having the paper at this conference. We are, guests on this circuit here. Thank you, Laurens Hepting, for the wonderful collaboration. This was developed from a speech that I gave with the same title at Frankfurt School of Finance last year, and the paper that we developed has been accepted for publication in a book edited by Thomas Walker, How Financial Innovation is Transforming the Banking Industry. It gives an overview of DeFi, our paper, and raises, I wouldn't even say completely discusses, raises an important question, which is the question of whether and how centralized finance, or also traditional finance on the one hand side, and decentralized finance will converge or will merely coexist, or whether DeFi will disappear. So let's go quickly through the paper here. I want to talk about basically these four pieces here. A quick introduction to CeFi and DeFi. Talk about the DeFi, CeFi fault lines, because these are different universes, and these fault lines, I think, need to be overcome, and regulators need to take those fault lines into account. There's a scenario analysis, and then there are examples of convergence initiatives, and I think we're going to see many more going forward. And then I will conclude with some also suggestions for future research. So I think the first thing is that the architecture of our current financial system is certainly, centralized. But there are at least two distinct perspectives on finance. One is an institutional perspective, the other one is a functional perspective, and that, I think, is what matters. The functions remain the same, but the institutional setup can change over time with the evolution of technology, and more importantly with the change in transaction costs, and I think that perspective is important. Technological progress can move the boundaries between institutions and markets, and I think it's also very important that we talk about the cost function of finance itself, and this is where DeFi can play a role in terms of automation, in terms of basically helping to reduce the cost of providing financial services. DeFi, I think this is the hierarchical model here from Scher et al. And has been discussed broadly in the literature. The various layers. DeFi is a very recent phenomenon, only emerged in 2019, 2020. Open, permissionless, highly interoperable protocol and application stack, agreements enforced by code. And what is important here is obviously the hierarchical nature.
because, you know, if you have an issue, whether it's a technical issue or a reputational issue at one of the levels, it's going to feed through and ripple through the entire layer model. And obviously, this is all built on the internet layer, and then on top of that, you have the settlement layer, the layer 1. Then you have an asset layer, and then at the core of it, in terms of DeFi, is the protocol layer. And on top of that, you have the application layer, and sometimes even aggregation layers that are centralized again, but define the user interface ultimately. So you can have a centralized, you know, user interface that is interfacing with the decentralized protocol. Other components that are not shown but are important for the DeFi universe are obviously the wallets, oracles, data storages, and there are even ID verification protocols out there. What is important, I think, is to properly evaluate DeFi protocols. There is no standard for evaluation yet, but I think that obviously the analysis of the documentation is important, protocol audit, use cases, quality of the team, reputation of the backers, the, you know, ecosystem, community, tokenomics, key metrics and ratios, and also a risk assessment. And I would say in hindsight, you know, Terra Luna scored high on all of those, but didn't score high in terms of, you know, tokenomics. So I think that is an important piece, the evaluation of DeFi protocols. There are advantages and disadvantages here which are important to be keeping in mind. One is obviously the wider access to financial services that was discussed. Potentially greater inclusivity, increased efficiency, reduced frictions, speed of execution, transparency, although there's an important distinction between you know, actual and theoretical transparency, increased standardization and interoperability. You know, software can basically interact with each other and is not captured and sort of bound by silos, and you have clearly, you know, robustness, censorship resistance, you know, which is obviously, you know, an important aspect in a deglobalizing world. You have DeFi disadvantages and challenges, which are important. The scalability issue is obviously a key issue. And an area of active research and technological development. You have smart contract vulnerabilities, which we need to keep in mind. That's a new risk, and the famous case is obviously the DAO, but there are many others. You have extreme short-term returns that have attracted certainly malicious actors. Operational security is a new area of risk. Centralization creep that was mentioned. In terms of also proof of stake, Oracle dependencies, and, you know, clearly it is still an immature technology, and certainly as of today still, you know, highly dependent on the Ethereum community and the Ethereum base layer, because, you know, roughly 2/3 of DeFi protocols are still running on Ethereum, although there is competition at that layer level now as well. I think it's useful to basically juxtapose DeFi versus CeFi along a couple of dimensions. I'm not going to go through all of them, but you know, clearly non-custodial wallets versus you know, custodian or bank. The units of accounts are obviously different. The execution happens in terms of smart contracts versus processing between parties with the help of an intermediary. The governance is different. The auditability is different. Access and privacy is an important distinction, of course, and also security. And last but not least, you know, investor protection, because it's you know, clearly an unregulated area out there. This brings me, I think, to the important discussion of fault lines. i.e. areas where there is a break in the system, where accidents can happen. Clearly the high volatility does not rhyme well with a quest for financial stability. The issue of scams and hacks obviously undermines consumer protection. The pseudo-anonymity is at loggerheads with KYC and AML requirements, legal and regulatory uncertainty, obviously, versus a regulated environment, functional view versus the institutional view, and with that I mean the perspective of supervisors as well as market participants, and then you have decentralized, although obviously we also know that some protocols are not as decentralized yet as they claim to be, versus single or few points of failure, and then the issue of underbanked versus less access restrictions for DeFi. In terms of scenarios, look, I think you can think about very crudely about 3 scenarios. One is whether DeFi disappears. I don't think it's going to disappear because there is a lot of investment dollars in that space. Yes, it's very small, currently less than $100 billion total value locked versus, several hundred billions or 300 billions of 400 billions of traditional assets. The coexistence, I think, is something that would mean that they would basically, not interact a lot. So the scenario here would be that DeFi and CeFi will just coexist with minimal linkages. I think that is also, not very likely, because clearly DeFi cannot exist, without larger volumes on the one hand, and on the other hand, I think there is significant pressure on the traditional financial system to reduce costs and automate. So I think that a convergence scenario is likely, even very likely, and because that would help to marry large pools of assets and the customer base and the trust. That is clearly with the traditional financial system, the centralized financial intermediaries, and the power of automation. Obviously, the question, how that can happen and how that will happen is open and depends a lot on how financial regulators, deal with that convergence scenario. Here are 2 examples that we briefly discuss. One is a very interesting one is the Goldfinch protocol, where basically people deposit, assets in a protocol, and then stable coins can be withdrawn, converted into fiat, and be lent out. So that's one example where basically the real world is tapping into the liquidity in crypto. The other example is one where a traditional financial player has actually begun to tokenize real world assets, and is basically using the power of DeFi protocols to basically collateralize that. And obviously, if you see something like that, you can immediately imagine how very large volumes of assets could begin to interact with these protocols, and then that immediately obviously raises the question, how is that going to work? Will that happen in whitelisted environments, etc., etc.? But these are 2 examples that we highlight in the paper. So in summary, I would say DeFi has the potential to create a new form of financial intermediation. But as with all nascent technologies, there are significant drawbacks and risks. So far, traditional financial institutions have been very reluctant to interact with crypto and and DeFi, but I think there is potential for synergy and benefit. And one of the problems is also that obviously, a lot of the crypto environment and a lot of the DeFi movement is, explicitly against the traditional financial system, I would say for religious reasons, sometimes also even anarcho-capitalism. But I think the point is here that it's about the technology, the ability to automate on top of a blockchain. And I think what we can see certainly is growing institutional interest, and I think people are beginning to explore bridging solutions because, the overwhelming majority of assets and wealth is still in the traditional financial system. So that convergence, I think, will and could be driven by the promise of higher automation, greater access, and certainly lower transaction costs. And, I think a huge field for future research, not only, from an economic point of view, but also from a technological point of view. Because, clearly, if we want to sort of run, larger volumes on DeFi and on blockchain, we need, much more scalability. So that concludes my presentation of the paper, and over to you for the discussion. Thank you.
All right, so thanks for the presentation, and thanks for giving me the opportunity to discuss the paper. It was actually a bit difficult for me to think about this discussion, because this is not like a traditional paper, right? So you were mentioning that it is already published as a chapter of a book, so congratulations for that. So I guess my comments and suggestions will not be very useful, but so I will try to be as brief as possible. Okay, so the paper provides a comprehensive overview of decentralized finance, and there is a very deep comparison between DeFi versus traditional finance, so decentralized finance versus a centralized system. And then most of the contribution of the paper, I think, is this scenario analysis, where the authors try to understand what's going to happen in the future. So is DeFi going to die? Is DeFi going to coexist with centralized finance, or something else? So the conclusion is that the most likely scenario is that of convergence. So there will be, let's say, cooperation and interoperation between CeFi and DeFi. So I believe it's, of course, a very interesting and timely topic. But I like this trend of literature. And I believe the paper is clear, well written, and it's very informative. And this is, it's not given, because there are many book chapters, articles, etc., talking about these topics, and they are far from being clear. But this account, I think, is really, really good. So I think I will use, some of the information contained in the paper for my own paper, for the introduction, etc. And I think it gives a fair, unbiased account of the current situation. So you're not like cheering for one of the two sides, but you try to give a very objective view of the pros and cons. And I really like these two examples of CeFi, DeFi convergence that you were mentioning. Actually, I didn't know about those projects, but they're very interesting. My first comment is about the contribution, because I believe that the original contribution could be improved, meaning that most of the paper is kind of putting together information from previous work. And the main part, as I was mentioning, where you actually give your original contribution, is the scenario analysis. And I think it could be, kind of expanded, because there are some arguments backing up why you believe that some scenarios are less likely than others. But, I think you could kind of improve the strength of those arguments. And also it could be interesting, in my opinion, to have some numerical projections. So for instance, you talk about the fact that many users in the DeFi space are younger investors. So it would be nice to try to understand what's going to happen going forward. So in 10 years, given that, there will be an exchange in generation, that, yeah, it would be nice to give some numbers about that. About the convergence use cases, I mean, I like those 2 examples, but it would be great to have a few more examples, right? So I understand that maybe most of the current projects in that direction are not deployed, they are not live yet, but it would be interesting to see if there are some projects in development stage, or rather, if you could identify some potential synergies. So, like maybe propose, even from an abstract perspective, some kind of interaction between CeFi and DeFi that would actually bring value on the table. I think this would add to the contribution of the paper. And my last comment is about payments, because I was quite surprised about the fact that you don't really talk about payment systems in the paper. And today we saw many papers about stable coins, and I think those are being highly utilized, especially for international transactions. So I think that's a specific sector in which decentralization is going to play a big role in the future. And so technological improvement in the future may actually amplify the phenomenon. So I think it's important to talk about it. And you mentioned the potential role of central bank digital currencies in the interaction between CeFi and DeFi, but I think you could say something more about it because it's a very, very important point. Okay, so that's it for my discussion. So I think we still have some time for Q&A.